Before we get into the backtesting, I just want to welcome you all back from holidays and I want to say Happy New Year. And as you can see in front of us, these are our 7-step trading plan checklist. These steps are basically the same, but I've just made it a little easier for each and every one of you to understand much better. Step 1, we draw a vertical line at 8:30 and 11 New York Standard Time on the 15-minute time frame. So we normally start our trading each and every day on the 15-minute time frame. Then we draw a horizontal line on a swing high and low nearest to price on that 15-minute time frame. Then step 3, when that high or low which we drew on step 2 is broken, we drop down simultaneously to the 1 minute, 3 minute, 5 minute time frame to look for a trading setup. So just like ICT says that price is fractal, whatever you see on the 1 minute time frame, you can as well see that same kind of setup show on the 3 minute or the 5 minute. So these are going to be the 3 different time frames that we are going to be looking for our trading setup. But now there is just going to be something very different with each and every one. For example, the 3 minute and the 5 minute, which I'm going to show later on in the video. So what is this setup we are looking for comprised of? That is where step 4 comes in. So we wait for an impulsive move that takes out a high or a low and forms a fair value gap. So let me demonstrate that to you guys right now. Looking at the chart, you say we are waiting for an impulsive move. So that's the first thing, right? So as you can see, do you see how this candle here looks like? So this is what we call, or this is what we look forward to, because this is an impulsive move. And we are looking forward to it taking out a low or a high and forming a fair value gap. So does this impulsive move take out a high since it's in a bullish direction? Yes. You can see it has taken out this high, taken out this high, and several other highs, including these other highs here. And has it formed a fair value gap? Yes, it has also formed a fair value gap. So what is a fair value gap? Where we have 3 consecutive candles, you can see this is candle 1, candle 2, and candle 3. The high of candle 1 did not meet with the low of candle 3. And when that happens, a fair value gap is being formed, and we draw that from the high of candle 1 to the low of candle 3, and we draw that out in time just like one of our rules here says. So we draw it and we wait for price to get back into that fair value gap. Another rule of this setup is we wait for at least 2 opposite candles to be formed before that move. This is the bullish impulsive move, right? So we are waiting for 2 bearish candles to form before. So the 2 bearish candles form before the impulsive move? Yes, it did. So that rule has been ticked. Then now for the impulsiveness, we want a displacement of at least 25 points. And how do we measure our displacement? So now the candle that is within the fair value gap, right? We want to measure it from the open to the close. That is just the body. If we measure it from down here to up here, you can see that our displacement on this candle is actually 110 points. All the rules that we are looking forward to our trading setup have been met. That is where now we go to step 5. We draw our fair value gap formed and wait for price to return. So we have already drawn the fair value gap based on this other rule here, and we are waiting for price to return, which price already did. This is just a demonstration. For step 6, we are going to be doing either of these when placing our trade. So the first, we place a limit order at the fair value gap with a stop loss above. So the stop loss is going to be above if it's a sell, and the stop loss is going to be below if it's a buy. So showing it here, that means this is the top part of the fair value gap, right, for the buy setup. So we're supposed to normally place our entry here, and our stop loss is going to be below here. That is the below the low of candle 1, and the opposite is going to be for a sell setup. Or we are going to place our limit order at the 50% of the fib. So another thing which we are supposed to do is we draw our fib. You can see from here, from this low to the high that was formed before price came back in, right? And as you can see right here, this is the 50% of the range. Then the last thing we do is we target the negative 0.5 level of the fib for our take profit. So no matter where you place your entry, if you are placing your entry at the fair value gap or at the 50% of the range of the Fibonacci, we are going to place our take profit at the negative 0.5 level of the fib. So with that said, let's get into the charts now and start doing our back testing. Right now on the charts, as you can see, we are actually looking at S&P. I normally always show Nasdaq on the channel, and many people always ask, does this work on S&P? Does this work on Forex? Yes, it does on Forex. I'm not going to ever test Forex, but I'm going to do only Nasdaq and S&P, that is the indices. This is just before 8:30, and as you can see, I've already done step 1 and 2. I've already drawn my vertical lines at 8:30 and 11 New York Standard Time, and these are my horizontal lines that I've drawn to demarcate the swing high that was formed before 8:30 and the swing low that was formed before 8:30. So what are we looking forward to now? We are looking forward to price actually taking out either the swing high or the swing low, after which we are going to drop down to the lower time frames to start looking for our trading setup. As you can see right here, this candle, actually this candle and this candle, they have taken out the swing high. With that, we are going to drop now down to the 3-minute time frame and we are going to start looking for our trading setup. And whatever we are doing on the 3-minute time frame, you can as well do it on the 5-minute and also on the 1-minute time frame. But there's something that is going to be different, which I'm going to show you as compared to the 1-minute time frame. So now on the 3-minute time frame, we are just going to start forwarding price to see if we are going to get our trading setup. We can see here that we had kind of a doji candle, which does not really show us if these are at least 2 bearish candles before the impulsive move. And also you can see we had quite a good impulsive move here, which was just 6 points. Now this is where what I was talking about comes in. On Nasdaq, I always say we look for at least 25 points or greater than 25 points. But now that same rule does not show here on S&P. So on S&P, what we are going to be looking forward to is at least 7 points, because S&P does not move as much as Nasdaq. Another thing that does not make this one of our trading setups is we want to see that for this second fair value gap, we want candle 3 to be bullish and not bearish. So that is not a trading setup. You can see a lot of volatile moves, a lot of big displacements, but no fair value gap or no setup formed. What do we see here? You can see here that as price has been going upwards, price has formed quite some good displacement with 2 fair value gaps. But now, does the displacement meet our rule? Not yet. So the displacement is 6 points, and as you can see, it actually met the other rules, right? At least 2 bearish candles before the displacement. It has taken out a high, but now since the displacement is not yet to where we want it to be, this is not going to be a trading setup. We can see at least 2 bearish candles before this good impulsive move. And if we measure the impulsiveness of this move, we see that it's actually 10 points. So that means 2 rules have already been met. And also this displacement has taken out this high. 2 fair value gaps have been formed, right? This is the lower fair value gap right here. And you can see we had a higher fair value gap at the top here. So now, if it was on the 1-minute time frame, like I always normally show on this channel, what we are just going to do is we are just going to draw our fib, right, from the low to this high, and we are going to place our limit order at the 0.5 level of the fib and the stop loss just below this low and the take profit at the negative 0.5 level of the fib. The difference with the 3-minute time frame is that we are not just going to place our trades, but what we are going to do is now the highest fair value gap that was formed, right, which is this one, we are going to drop down to the 1-minute time frame and we are going to look forward to seeing if there is a smaller fair value gap within this 3-minute time frame fair value gap, where now we are going to place our trade. And what that does is it gives us a smaller stop loss, but still with the larger take profit, which is right up here at the negative 0.5 level. Now on the 1-minute time frame, you can see this was the higher fair value gap that we talked about, and we are looking now for the first fair value gap that has been formed within this on the 1-minute time frame, where we are going to be taking our entry. And as you can see right here, this is a smaller fair value gap, and that's the first fair value gap that has been formed within the 3-minute fair value gap, and that is where we are going to be placing our trade. And as you can see, it's going to give us a smaller stop loss because we'll be placing our entry right here on the low of candle 3 of this fair value gap. Our stop loss is going to be down here on the low of candle 1 of the fair value gap. Then our take profit is going to be all the way up here at the negative 0.5 level of this entire 3-minute range. Now we have placed our trades. Let's see what price is going to do. Here we go. So as you can see, price got us or tagged us into the trade right here and stopped us out of the trade in take profit right here. That was like a 1:4 trade. And you can see as price was going towards getting to our take profit. It came all the way down, getting close to our entry before getting back to our take profit. So you just have to be very confident with the strategy to know that no matter what, if you are on the right direction or if you are in the right direction, price is going to eventually get to your take profit. Looking at the charts, we have gone to Nasdaq. I've just broken down the strategy and shown you an example of the strategy working on S&P. So now let's backtest the strategy on Nasdaq. I have already done step 1 and step 2 on the 15-minute time frame and even step 3. And now I've dropped down to the 1-minute time frame where we are going to be looking for our trading setup. Looking at the charts here, we can see something very interesting, right? At least 2 bullish candles before this kind of impulsive move. We are going to measure it. Then you can see it took out this low right here and also this low right here. So let's measure the displacement and see if it meets our rules. Yes, the displacement meets our rules. That is 36 points. Now back on Nasdaq, we want to see something greater than 25 points. But on S&P, we're looking for something greater than 7 points. Since this is on the 1-minute time frame, we go directly to drawing our fib from the high to the low. That is the high of candle 1 of the first fair value gap, which is right up here, to the second fair value gap, which is right down here. Then the next thing we do is placing our trades. Our entry was exactly at the 0.5 level, or that is the 50% of this range. Our stop loss was at the above the high of candle 1 of the first fair value gap, and our take profit was at the negative 0.5 level of the fib. So let's see what price is going to do.
Nope.
Okay, so you can see price just continued extending without getting back to our entry point. So at this point, we are just going to delete everything and start looking for another trading setup. I can see something very interesting also showing up here. You can see at least 2 bullish candles before this good displacement downwards. And if we measure the displacement, we can see that the displacement is actually 39 points, and that is greater than 25 points. So with that, we are going to draw our fib once again from the high to the low. Then we mark out the fair value gap from the low of candle 1 to the high of candle 3. So you can see this displacement actually took out this low right here, and it has actually met all our rules. And also this candle, even though it shows like a doji candle, but it's actually a bearish candle. Right now we are going to place our trades.
Nope.
Price actually came in, filled our fair value gap, then it just went below the 0 level, that is the low of our entire range. Whenever price does this, immediately I take out my trades, like I cancel my orders if price did not fill me in, because at this point price might just either go down to our take profit, or it might reverse and instead come and take us out of the trade. This kind of looks like another setup, right? At least 2 bullish candles, nice bearish impulsive move that took out this low. And if we are to measure the impulsiveness of that move, you can see these 2 candles here, it's 34 points. And let's see. Actually, it formed 3 fair value gaps. So 1, 2, and 3 fair value gaps. And if we are to measure all the impulsiveness of the 3 fair value gaps, it's actually 56 points. So we draw our fib once again from the high to the low. Then we'll be anticipating for price to come now to the 50%. Then we are going to get our entry.
Nope.
But as you can see, price just kept on extending, and price has actually formed so many other fair value gaps. Now this is actually 4, and at this point, when it forms so many fair value gaps like this, I just feel like the setup is no longer valid. I can see something interesting here, right? At least 2 bullish candles before this impulsive move downward that took out this low. And if we measure the impulsiveness of this candle, just the one within, oh, there we go. We actually have exactly 25 points. So with this, we are going to do what we always do. We draw our fib from the high to the low. So we are drawing it from the high of candle 1, right? Of this fair value gap, which I'm going to draw right here. This is the fair value gap within the range. Then so it's from this high to this low. So at this point, we are going to place our trades, because as you can see, the 50% of the range actually is just right here at the low of the fair value gap. So we'll just place our trade right there at the low of the fair value gap. Stop loss at this high. Then our take profit is going to be negative 0.5 level of the fib. Okay, let's see what price is going to do at this point. Okay, we got tagged in right here on the next candle. So let's see how price is going to play out. Okay, as you can see, price has come and taken out this low. And normally what I always say is whenever price comes and takes out this low, we always place our trade to break even. Because at this point, price can either go to our take profit or return and go all the way to where we had placed our stop loss. Oh, as you can see, price actually came and took us out at break even. And if we forward, you can see eventually price would have taken us out at our stop loss if we had not even put our stop loss to break even. So these are the kind of scenarios that you can get in a particular week or maybe continuously in your trading as you trade. And I just wanted to give you realistically what you can expect with this 7-step trading plan checklist which I've given to you. Now is the time for you to go and backtest for yourself and see the kind of results we are going to get with it and get familiar with it, get confident with it. With that said, catch you guys in the next one.